Good afternoon, everyone, and welcome to our newest episode of the Manufacturing Minute. As a reminder, this podcast aims to update you on the trends and hot topics shaping the world of manufacturing. I am Megan Meador. I'm the host of the podcast, and I'm an audit and assurance partner with Brown Edwards. I am the manufacturing and distribution leader for our practice, and I'm based out of the Bristol, Tennessee office. Today, I am very pleased to announce our guest speaker, which is Rich Hedley. Rich is a partner with our practice. And Rich, so thankful to have you on the podcast today. You want to tell our listeners and our viewers a little bit about yourself?
Well, first of all, good afternoon, Megan. I'm happy to be here.
Thank you.
My name is Rich Hedley, as you said, and I'm the state and local tax leader for Brown Edwards. I've been with Brown Edwards for 7 years now, and it's actually my 27th year in public accounting.
Wow.
That just ages me, that's all. Well, in addition to state and local tax, I do serve a wide variety of clients, primarily closely held companies that are pass-through entities, partnerships, S corporations, and in a wide variety of industries, real estate, construction, and of course, manufacturing. With our SALT practice, we help our clients, navigate the complexities of state tax law, because as we all know, every state is different, which makes it difficult to keep track of the ever-changing state tax law environment. And states are also looking to raise tax revenues, so businesses are finding that they are being contacted more and more by the state taxing authorities. So, Brown Edwards offers a wide range of state and local tax service offerings that can help our clients navigate these multi-state complexities. And I'll go over those a little bit later in this presentation.
Yeah, we appreciate and look forward to hearing what those are. I mean, as most of the listeners and viewers of this podcast are, in the manufacturing and distribution space, why should they care about state and local taxes?
Well, SALT, as I like to call it, can have a significant impact on a manufacturer's cash flow and operational decisions. Federal tax is complicated enough. With state tax, you're dealing with thousands of jurisdictions, each with different rules, because you're not just talking about income tax, you're talking about sales and use tax. You're also talking about property tax. So for manufacturers, they need to be able to navigate those complexities of multiple different laws and regulations. And, the consequence of ignoring multi-state issues can be very costly and can eat into that cash flow that they need to have for their operations. Penalties and interest can add up quickly.
What are some of the first types of issues that you see specific to manufacturers related to SALT issues?
Well, Nexus issues are really what we see, because manufacturers need to determine where they need to file tax returns, not only income tax returns, but sales and use tax returns. It's important for them to understand that, because again, cash flow is king for them. So it's important for them to understand the tax obligations of the company, not just from a federal tax perspective, but from also a state and local tax perspective.
Well, maybe that's a good segue for us too. Can you talk to our listeners a little bit about Nexus and what Nexus is, and how can you determine when and if you have Nexus?
Yeah, absolutely. Really, to put it simply, Nexus is just a connection between a taxpayer and a taxing jurisdiction. And that connection has to be sufficient enough for that state to be able to impose a tax, whether it's income tax, sales tax, or property tax. And that's really the key phrase, sufficient enough. Many states have differing laws that govern what connections are sufficient enough to create Nexus. And while many states have similar themes that could create Nexus, there's still a lot of nuanced differences between each and every state. And that's where Brown Edwards can really help manufacturers navigate those differing rules. And what's very important to know is that physical presence really always creates Nexus. And when I talk about physical presence, I'm talking about your people, your employees, property, your inventory, machinery and equipment, that kind of stuff. If you have a physical presence within a state, that's almost always going to create nexus. But what manufacturers and other businesses need to understand is physical presence really is no longer the only standard, which adds to the ever more complex issues with state and local tax. And that's economic nexus and factor presence nexus. It's becoming more and more prevalent. Most states really want to move away from physical presence being the only nexus determination. And really, if you think about it, that's because everything is online these days. Businesses don't necessarily have to have a physical presence in a state to do business in other states. So states are becoming more aggressive by utilizing economic nexus standards. And the reason for this is, states don't want to miss out on tax revenues. They just because a state is not physically located in a jurisdiction doesn't mean they're not doing a lot of business in that state. So they don't want to lose out on that, which again, the complexity is added to all that.
Oh, yeah, especially in the past, 3, 5, 7 years, something like that. The definition of nexus and the measurement of nexus is not what it used to be. You're throwing out this term, Rich, economic nexus. What is that and how is it measured?
Well, economic nexus is really measured by a business's level of economic activity within a state. And it's almost always using one or both of the following metrics. And the first metric is revenues or gross sales within the state. And the second is number of transactions. Although a lot of states are moving away from this number of transactions concept and mostly just focusing on gross sales within a state. For sales and use tax purposes, there is a bright line sales number that creates economic nexus. And for most states, that's $100,000. There are a number of states that have higher thresholds than that, but if you think about it, the vast majority of the states will be at the $100,000. And like I said, many states have gotten away from the number of transactions metric, but if a state still uses that number of transactions method, then it's typically 200 transactions or more within that state. And how do you measure gross sales by state? It's typically a destination-based sourcing. So for manufacturing, for both income and sales and use tax, the sale is measured by the location of the business's customer.
Okay. So shipping point, otherwise, where they're shipping the product to
Right.
that customer, that would be where the nexus is measured and allocated and gathered at that point.
Well, and what else adds to the complexity is that economic nexus standards can be different for income tax purposes versus sales and use tax purposes. So that even adds more complexity to it. Because for income tax purposes, like I said, with sales tax purposes, there is a bright line test. For income tax purposes, not all states have a bright line test for economic nexus. They all say that economic nexus creates nexus for doing business in the state, but they don't all have a bright line test. So it makes it more difficult for businesses to evaluate whether or not they should be filing a tax return for income tax purposes.
For SALT purposes, once Nexus is established, so we just went through how if I'm a manufacturer and I'm shipping products to multiple states or multiple areas, I've established Nexus in that state or area. What do I need to do next? What if that's a new location or a new customer? If I'm a manufacturer and owner of a business, what's my next step?
So the next step would be registering in the state effectively. If it has been determined that you do have nexus in that state, registering for that tax is what's next. And then after that is actually determining what your tax would be to that state. And that is done through what's called apportionment. And quite simply, apportionment is just a method to determine the business taxable income that's subject to tax in that particular state. And it's really just a formula. It's total sales within the state divided by total overall sales of the company. And it gets you to a percentage. And then you apply that to federal taxable income subject to state adjustments. And if you think about it, states don't always conform to what federal tax law is. And you see that mostly with tax depreciation. So federal tax depreciation has 100% bonus depreciation. There's a lot of states out there that say, nope, we're not going to adhere to 100% bonus depreciation. So you're going to have to make an adjustment to come to state taxable income from your federal taxable income using an apportionment figure. And to make things even more complicated, apportionment rules vary by state. Of course.
Of course.
Some states have three-factor apportionment, but that's taking your sales in a state divided by overall sales. They also have payroll, so you have to take your wages by state compared to overall wages, and then property, your property within the state divided by overall property. So, and those factors can be weighted differently as well. So just because it's a three-factor state doesn't mean that same three-factor state is the same as another three-factor state. So all these complications add up, and that's where we can help clients with their state tax filings and with understanding exactly what is needed for those state tax filings. And a lot of states are moving more toward what's called a single sales factor approach, where they're just concentrated on sales and sales within the state divided by overall total sales. And what's good with manufacturers is there are some special apportionment factors specifically designed for manufacturers. And Virginia is actually one of those states, because Virginia typically is a three-factor state, three-factor apportionment state for most businesses. But if you meet certain criteria, if the business meets certain criteria, and it's typically a wage-based, if that company pays their employees a certain amount of their wages higher than the norm, then they could potentially use a single sales factor apportionment. And why would you want to do that? If they have all their employees and all of their property is in Virginia, so you're effectively 100% apportionment with those two factors, and if you're only averaging a small amount of Virginia sales compared to other states, having a single sales factor can lower your apportionment percentage, which can be a significant tax savings, particularly for C corporation manufacturers.
So you're obviously an expert in all of these topics because you know your stuff, and I'm sure that you've seen a lot over your years. Seems like sales tax is always a hot topic. What are some common pitfalls, or maybe even a story or a case study that you've seen where a manufacturing company has maybe ran into a hot spot or some issues regarding salt issues?
Well, some of the biggest risks with state sales and use tax is the filing requirements and whether manufacturers have Nexus in multiple jurisdictions. Physical presence, and I'll say this forever, creates Nexus in all cases. Economic Nexus has that bright line test that we're talking about. And really, the issue becomes, physical nexus can have some common traps for businesses that aren't thinking about it. If they have inventory in third-party warehouses that are out of state, if they're like staging inventory in another state to help with shipping costs or something, that can create nexus, and they're not even thinking about that. Is the business sending service technicians across state lines? Do they have remote employees working in another state? Does the business send employees to trade shows? Okay. That's a common thing where people or manufacturers will send people to trade shows, and they're thinking they're only there 1 or 2 days. That shouldn't create nexus, or they're not even thinking about it at all. But 1 day can certainly create nexus in some states, particularly, I've seen it in New York where they've asserted nexus, Massachusetts, and these are some higher income tax states and sales and use tax states, per your specific question. So it's incumbent upon them to understand that physical presence creates these nexus risks as it relates to sales and use tax and income tax. And as far as an opportunity for sales and use tax, manufacturing exemptions from sales and use tax is a great thing that people need to be aware of. And particularly in Virginia has some manufacturing exemptions for machinery and equipment that's actually used in the production of their product. But the complication becomes what actually qualifies as a machinery used in production. The machine itself is easy, yeah, but what about other things that are attached to that machinery? Would those parts, would those ancillary support equipment, would those qualify for sales and use tax exemptions? And most states apply what's called a direct use test, meaning that the machinery must be an integral part of the production of the product and not just supportive. So it's a gray area for sure that could result in either overpaying tax if you missed that exemption or underpaying tax if you're applying an exemption when you shouldn't be. So and that's where we can come in and help make sure that they're applying that exemption appropriately.
You just talked a little bit about machinery and equipment and parts, and how that relates to state and local taxes. What about property taxes? So, I see it often that a lot of our manufacturing companies, and, in my past, I worked at a coal company too. And every year we would have to go through and scrub the fixed asset listing and make sure that, all that little stuff that was being kept on those registers and being turned into the authorities that we were paying property tax on, if it was being disposed of or if it wasn't there, we were cleaning that off. So, property tax doesn't seem to usually get as much attention, but should our manufacturing clients be paying attention to some of those listings?
Absolutely.
Yeah,
I like the fact that you were actually scrubbing your fixed asset listing because a lot of businesses kind of ignore that,
let it
and that's
go.
where
Yeah,
that's where issues can come into play. You know, it's a fairly simple computation when you have different rates that apply to different types of equipment. And property tax is calculated on that base value, furniture, fixtures, machinery, equipment. So effectively, the value is multiplied by that tax rate that is determined by the local taxing authority. Companies can't really control what that tax rate's going to be other than through lobbying and through elections and all that. And we know how effective that can be, right?
right.
So really the best way is controlling that tax base, that value to make sure that it's as low as possible. And where we see a lot of mistakes is the misclassification of assets. So it's important to evaluate the mix of business personal property to make sure they are in their proper categories. And, again, it's because personal property has differing tax rates depending on what it is. And for manufacturers in particular, machinery and equipment typically has a reduced tax rate, and particularly in Virginia. Inventory, make sure your inventory isn't anywhere close to these personal property tax returns because, for the most part, that's exempt.
Correct.
So you should make sure that that's not part of it. There's also opportunities like appealing assessments. Many companies just accept their tax assessments and may not even take the time to evaluate the assessments. Those assessments can be appealed where it makes sense. Look at making sure that the original cost basis isn't incorrect. Going back to what you were saying, scrubbing the asset list to make sure that assets that have been disposed of aren't still being reported. Making sure you're not double counting assets or misapplying any depreciation schedules. Looking at what that assessed value is when you actually get the assessed value and making sure you don't think it's exceeding the fair market value of those assets. So yeah, there's a lot of stuff that can be done in order to reduce your property tax bill because it can be one of the largest bills that any company gets, not much less a manufacturer.
Well, I think I'd love to put you on the spot towards the end of our podcast here. And our listeners always love a good story, especially a good story where you were able to save a client some real dollars. Can you think of a success story that you've had recently, whether it's through, property tax or maybe a state and local tax study that you performed where we really benefited and, back to that cash dollar savings, a manufacturing company?
It, not quite a manufacturing company, but it was a company that does a lot of lumber work. North Carolina sales and use tax. And sales and use tax is a big one for us where we can save a lot of money for clients. They had Nexus in North Carolina and were never filing any North Carolina returns for sales and use tax purposes. We were able to get them into what's called a voluntary disclosure agreement with the state of North Carolina. And we saved them over $90,000 in penalties. So voluntary disclosure agreements are a big tool to help limit penalties and interest being assessed by state authorities.
And is that basically saying this wasn't intentional? We are sorry. We come to you humbly, state of North Carolina. We want to make this right. Is that kind of what that looks
That's
like?
absolutely correct. What happens with a voluntary disclosure agreement, at least with most states, is that you outline the facts of the case to the state anonymously. So you're not coming forth yet as the taxpayer. You're anonymously telling them the facts, and then they'll either accept it or they won't accept it. And what happens is they will limit the number of years of filings to, it's usually typically 3 or 4 years, and they will also typically abate any penalties associated with those years of filings. And then you can start filing those sales and use tax returns moving forward prospectively
And
after.
that's attracted to them, right? Because they're going to get that, revenue on their side going forward. So they're willing to work with you normally, is my understanding of these situations.
Yeah, and you also, in order to qualify for a voluntary disclosure agreement, they can't have already contacted you through a notice, okay, or any kind of Nexus questionnaire. So they are so willing to accept these voluntary disclosure agreements because they don't know about you effectively. So that is why it's attractive. $90,000 of penalties is a big incentive to come forward and pay the tax that they should have been paying all along, and to limit, because in this particular case, they had been doing business in North Carolina for over 15 years.
Wow.
So, technically, if you have not filed a tax return, there is no statute of limitations. So the state could come back and, I practically they probably wouldn't do it, but theoretically they could go back at the full 15 years and assess penalties and interest on top of the tax. So being able to limit it to 3 to 4 years is great. It's very good for the taxpayer, and coming clean when the state doesn't know about it is great for the state.
Right. Well, Rich, I really appreciate your time today. This is another topic that I see every day. I'm in working with my manufacturing clients. Could we close out and maybe tell our listeners a little bit about the services that you can offer through Brown Edwards that could potentially help them in situations like this?
Yeah, absolutely. We talked about it earlier, Nexus studies. We perform these studies to help determine what states businesses and manufacturers should be filing in from an income tax perspective and from a sales and use tax perspective. And then once we know the states to file in, I'll reiterate, Brown Edwards can help prepare and file what's called these voluntary disclosure agreements, assuming the states have not already contacted you about the tax liability that they think you owe. And then sales and use tax reviews. So we can try to identify refund opportunities to ensure companies' business systems are properly calculating sales tax, and that you're not missing out on use tax. That's where we see a lot of things too, is people that might have resale certificates that are buying products to resell to others sometimes miss out on, if they're actually using it in their business, that they're not assessing use tax on those products, which can get people into trouble. So we help to assess those kinds of things in order to maybe identify where you're not paying the right tax, or identify where you're paying too much tax, and some refund opportunities. And then we do help with state tax audit representations, particularly here in Virginia, because Virginia is pretty aggressive with sales and use tax audits. So we can help mitigate any tax assessments that Virginia might assess.
That's helpful. And again, if our listeners are interested in contacting us regarding these services, both Rich and I's contact information is out there on our website. Rich, again, really appreciate the time today. And
I appreciate being here. Thanks.
yeah, absolutely. Thanks
Yeah.
so much.
Yeah. Have fun.
Thank you.